Joining me now is Christoph Amberger, Executive Publisher of Taipan. Christoph is going to provide us with more insights on the Dow, oil, and gold. Christoph, welcome.
Thank you for having me.
Christoph, Andrew made a bold prediction with his $30 oil price. Care to join him and make a prediction on where you see the Dow headed?
Well, Sandy, let me just take one step back and go back to the new historic high of the Dow. You remember the other historic highs of the Dow in the past, 5,000, 7,000, the last one back in 2000. You remember the headlines in the newspapers. You remember celebrities ringing bells and making quite a show of it. I brought today's Baltimore paper in here, and here you see the headline, "A New Way to Pay for Maryland Roads." Last time we saw the Dow in this lofty level, people were talking about irrational exuberance. Sandy, I ask you, do you see any exuberance in this market?
Well, you're right. I haven't seen a lot of it being reported in the press, but let me ask you this question, Christoph. Perhaps investors are being cautious right now. After all, when Alan Greenspan coined the phrase back in the early 90s, it was a warning to investors that we had reached the height of the dot-com bubble. So isn't it very possible that we've experienced this before, so we're taking a more cautious approach, and that's why we're not seeing this irrational exuberance everywhere?
Well, it's a matter of chronology. Actually, Adam Greenspan warned of irrational exuberance several years before the peak of the bubble was reached. As you remember, bubbles are a perfect place to make money. And institutional investors, hedge funds have exploited and popped every single bubble we had this year, from the carry trade over real estate, over gold, into commodities. I believe with the popping of the commodity bubble, with gold down yesterday below 560, with oil down going toward the mid-50s, I think we're seeing another shift of capital away from these small bubbles, simply because of the facts that bubbles make money, and funds and professional money managers would like to be in environments that produce profits for themselves and for their shareholders.
Okay, you just mentioned gold, and of course, as we know, it did drop like a lead balloon yesterday. Should investors be concerned about the plunge in gold prices?
Well, if I had bought at the top of this recent gold spike in the $700 per ounce range and up, I certainly would be uneasy. I do believe that a lot of the gold buying, much like the oil buying that pushed up prices in the last 3 years, was a result of speculation. Speculators like upward environments. That upward environment is very uncertain. Nobody likes uncertainty if you're managing money. I believe there is plenty of downward room for gold.
Okay, but you're seeing gold more as a speculative play than a long-term play.
I think gold is an asset just as any other asset, just as pig bellies or orange juice, and you should treat it as such.
Okay, and now you also mentioned oil, and we know that the prices fell, but they rose slightly when the news broke about armed forces in Nigeria. And then Chavez suggests that $60 for oil is a fair price. Now, should we be concerned about these neocon countries and their take on oil?
Well, Chavez and all our petro-communist new friends that we have around the world depend on high oil prices because they really have nothing else going for them. You will remember Iran, Venezuela, even Saudi Arabia are typically the ones who are predicting $100, $200 per barrel prices, and simply, cannot pleasantly live with the fact that oil may be on its way down. The fact that Chavez identified a fair oil price for crude, and I'm not sure if he is talking about Venezuelan crude or world market crude, at $50 a barrel, actually shows us that there is plenty of downward momentum for gold and quite a bit of danger to regimes who have financed their recent largesse mainly on petrodollar profits.
Okay, let's turn this around and put it in terms that the investor can understand. Do you have any specific recommendations or advice for our viewers to take advantage of these neocon oil conglomerates?
I think you should be not rushing out of your oil holdings. I think you should look at them from a somewhat removed perspective. You need to establish trailing stops, typically about 20% I would recommend. And also look at further exploration and maybe drilling stocks who still have backlogs for 18 or 24 months even that oil companies will continue to fill. I also see considerable upward momentum still in this still existing terror premium and the danger premium in oil. Remember, this oil drop has occurred during a relative lull in international terrorist activity. Any significant attack on oil targets could create spikes of probably 10-15% overnight.
Let me just summarize them quickly because we're running short on time here. You're suggesting then that if investors are in oil, they should stay there.
Stay in oil. Watch the stocks. Oil is going to be a long-term investment other than gold. There's always going to be demand for it. India is not going away, China is not going away, and the US economy is not going away. These are the three major oil consumers, and you want to use any dips in stock prices for oil stocks to really feather your own nest.
Okay, well, that makes perfect sense. Thank you, Christoph.
Thank you.
Now, you've heard three views on oil, the Dow, and gold. Andrew made his bold prediction of $30 for oil. Adam offered you a storm warning as he sees the Dow dropping down from its record high. And Christoph gave us a view on what he calls the neocon oil regime. For more details, let me encourage you to check taipanfinancialnews.com. By doing so, you'll get more insights as well as how to play these predictions for maximum returns. Until next week, here's to great profits from smart investing.